The big technology stocks extended losses as small and cyclical stocks gained on a surprisingly strong US GDP read yesterday. While European stocks don't really benefit from these rotation vibes that we see in the US due to a weak earnings season, but note that calls for a rate cut from the Federal Reserve next week will only get louder these days. So we have one more data point to go before next week's FOMC meeting and decision, and it is the core PCE index, which is the Fed's favorite gauge of inflation, due later today. So, welcome to Swissquote's daily market talk and happy Friday. So we went from the Fed could hardly cut the interest rates in September to it would be a mistake not to cut the rates in July or the September meeting. So I'm citing a post that I saw on Mohammed El-Arian's LinkedIn feed here. So yes, we just went from that extreme to this one in one blink of an eye. So it's normal that we see the market get a little bit anxious and nervous about things. So everything right now seems quite upside down. That's pretty much since last week. The big technology stocks that have been rallying relentlessly since the beginning of 2023 are hit hard by rapid outflows that we see on worries regarding the AI spending from big technology companies and the realization that it may take some time to see the benefits of these massive AI spending will push investors to take a part of their profits and walk away. Walk away where? Well, walk away toward the treasuries and the government bonds with the expectation that the Federal Reserve and other central banks will probably start or continue to cut their interest rates and will walk away again toward the smaller and toward the cyclical pockets of the equity markets as well. In this respect, we've been seeing the lower S&P 500 and Nasdaq countered by a rise in economically sensitive sectors since about 2 weeks now. And diving into the S&P 500, around 300 of the stocks in there actually gained at yesterday's trading session. US crude rebounded after testing the $77 per barrel support to the downside, and the Russell 2000 stocks rallied 1.26%, reinforcing the rotation trend from technology to non-technology sectors after the latest growth updates show that the US economy not only secured a 2% growth but grew at an impressive pace of 2.8% in the second quarter of this year, double the first quarter number, which had seen the growth in the US fall to 1.4%. Now, consumer spending grew 2.3%, and that obviously helped keeping the US economy on a strong path. Although I just want to open a small parenthesis here and say that, the US savings are melting and their credit card debt is rising to levels not seen in a decade. But it's just probably me seeing the glass half empty here. But whatever it is, US consumers spend, and happily though, core PC prices eased from 3.7 to 2.9% during the same quarter. And although the easing in prices that we saw in the second quarter was not as much as analysts expected, the Federal Reserve rate cut expectations didn't really got hurt by the strong numbers yesterday. It is now thought by some big names out there that not cutting the interest rates in one of the two next meetings from the Fed would be a policy mistake. I personally think that cutting interest rates next week would be a policy mistake too, given the still strong inflation numbers and this unbelievable growth that we see in the US. But hey, we will see what the Federal Reserve decides next week. At this point, activity on Fed funds futures don't show a meaningful bet for a July rate cut next week from the Fed. The probability of a rate cut next week is given less than 7%, and that's almost nothing. Now we have one more important data to go before next week's FOMC decision, and that's the core PCE index, nothing other than the Federal Reserve's favorite gauge of inflation. So that number is expected to show a slight slowdown from 2.6 to 2.5%, although we may see a certain quickening in the monthly figure, but all in all, if not catastrophic, the Federal Reserve will probably hint at, well, an interest rate cut is coming in fall in September meeting when they meet next week. So voila, the US 2-year yield shortly fell to 4.34% yesterday despite the strong GDP read from the US. The 10-year yield sits on the 4.25% level and the US dollar index hovers around the 200-day moving average as the economic picture wasn't as sunny as in the US elsewhere. On the contrary, guys, weak French and weak German business surveys yesterday came to complete the cloudy picture painted by the PMI surveys printed earlier in the week in the Eurozone. And also the earnings from the European companies this earnings season are less than enchanting, to be honest with you. And that obviously prevents the European stocks from benefiting from the sector rotation and reflation vibes that we see in the US. So Kering, which is the house of luxury brands including Gucci and Balenciaga, well, dropped 7.5% yesterday after warning that its profit is set to tumble in the second half of this year and pulled LVMH, Hermes and Burberry down with it. Note that Hermes, on the other hand, couldn't escape the luxury sell-off that we saw yesterday, even after, well, it announced that its own sales jumped in the second quarter. And Stellantis fell more than 7% after revealing that their earnings plunged in the first half of this year, and Nestle dropped 5% yesterday after downgrading its sales outlook for the year. So all in all, the earnings didn't look great here in Europe. So if you do an overall summary, around 40 of MSCI Europe stocks released their earnings this far for the second quarter, and only half of them have beaten analyst forecasts. So the stock 600 really looks toppish right now. And while the weak economic data and meager earnings from the European companies boost the European Central Bank rate cut expectations for September, but I don't know if the European Central Bank alone could cheer investors up at this point. The Eurodollar found support near the 108.25 level yesterday, and that despite unpleasant news and data from Europe. But the sticky US growth actually limits the Federal Reserve's rate cut potential, in my opinion, hence could also limit the euro's upside potential against the greenback moving forward. Now elsewhere, the dollar yen tipped a toe below the 152 level yesterday, and that was on rising expectation that the Bank of Japan could hike its policy rate next week. But note that the Bank of Japan is not the Fed or is not the European Central Bank. It is not because investors expect something that they will do what is expected. They could actually very well come out and give a cold shower to all of those who expect to see a rate hike from the Bank of Japan next week, and that would obviously punch the long Japanese yen positions in the face. But one thing is clear as this week comes to an end, and that's that the central banks are on a clear easing bias, except for the BOJ, of course, and the economic data and earnings in Europe and in the US are, well, quite under pressure, except for the US growth number, which curiously remains, well, quite strong for some reason. So this week actually saw two US big technology companies' earnings disappoint their investors, on top of the disappointing earnings from the European companies, of course. This week also saw a surprise rate cut from the People's Bank of China and a second rate cut from the Bank of Canada that was expected and witnessed influential people like Bill Dudley and Mohammed El-Ryan will start calling for an interest rate cut by the Fed as soon as next week. So we can't wait to see the rest of the earnings and what the Bank of Japan, the Bank of England, and the Fed decide next week. But this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.